Hello everyone and welcome to this Economic Impact video. Today is October 11. This is for the extended family of National Bank of Canada. My name is Martin Gagnon and as usual, I am with our economist Stéfane Marion. Hello Stéfane.
Hi Martin.
Stéfane, the last time we spoke, it was mid-September. We said let's be careful. And just after that, we did have some pretty hawkish comments from the Fed.
Yeah, Martin, no pivot yet for the Federal Reserve. If anything, they've added even more market uncertainty by providing their forecast for interest rates, where they now claim that they will move interest rates higher than what they said earlier this summer, and then they will keep them higher for longer, Martin, through 2023. So clearly, not a market-friendly message that we got on September 21st from the U.S. Federal Reserve.
And we did see quite an impact on the currency market.
And I think that's important to mention, Martin. The US dollar actually surged to a new record high. We're actually exceeding the worst that we saw during the pandemic. What's happening, Martin, is that this is the Fed leading all other central banks with their higher interest rates, leading to currency appreciation, which increases global financial stress, Martin, because other central banks are forced now to defend their currency. So if you take it all together, US raising interest rates, US dollar appreciation, other central banks raising interest rates, global financial stress now is well above average. The good news is we're not back to the worst that we saw during the pandemic or in 2012, but clearly, Martin, more financial stress globally is now being observed.
And there is some collateral impact, obviously, with all of this.
Well, at some point, you will get collateral damage on the economy. It's exactly what we're seeing right now. The global manufacturing sector actually showing contraction for the first time in 3 years. Not all regions are in contraction, Martin. North America is still expanding, but other parts of the world, many emerging markets, as well as Europe, are in contraction mode. So more uncertainty for the earnings outlook for global corporations.
And we're seeing quite a disparity in the stock market performance, and especially on the emerging market side.
Oh yeah, and this uncertainty about the outlook for profits is taking its toll on some markets. Emerging markets are now down 32%. From their previous peak. You can see that the US is at new cyclical low, Europe now in bear market territory. So most important benchmarks, equity benchmarks, are now in bear market territory. The good news for now is that Canada continues to resist, Martin. We haven't touched a bear market territory so far this cycle.
And let's look at this. We've talked about this before. Bit of a safe haven in Canada, right?
Well, at this juncture, we're down 12%. Everyone's down, Martin. We're down less than other markets just because if you look at the composition of the S&P TSX, we have more energy, we have more commodities, more agricultural products that are produced in this country. So that brings more resilience to the Canadian economy. So even though we're down significantly less than others. Why? Because we benefit from this current environment of geopolitical stress and high commodity prices.
So, Stéfane, the number one question we're receiving is the following. Will the central banks create a recession in their fight for inflation? How do we look at this?
That's a risk, Martin. And clearly, when you look at financial markets, people tend to look at the yield curve as the primary signal of an incoming recession. I will say, if you look at the 10-year minus 3-month tenure in the US. This is how the US Federal Reserve looks at the shape of the yield curve. It's very flat, Martin, but it's not inverted. So that's good news. So I would say that at this juncture, the risks of recessions are clearly increasing with the Federal Reserve maintaining a very, very harsh word relative to interest rates and inflation. But the yield curve has yet to invert, Martin. So what happens on inflation in the coming weeks will be the key determinant as whether or not the Federal Reserve decides to invert the yield curve, which would then be a leading indicator of an incoming recession.
So, Stéfane, we don't often talk about money supply, and we actually ignored it during the pandemic. But it's important to go back to our economics classes and take a look at this to have a sign of what inflation is doing.
So it remains to be seen if the Fed inverts the yield curve, Martin. All will depend on inflation. I think the good news that we have right now with respect to the outlook for inflation is that money supply, which was completely ignored during the pandemic, the central banks were working under the impression that you can lower interest rates, inject liquidity in the markets, leading to a surge in money supply with no impact on inflation. Well, history proved them wrong. And now the good news, however, Martin, is with the recent tightening in financial conditions, money supply is decelerating quite significantly. And if you look at the slide historically, when money supply grows at 3% only, you don't get much inflation. Actually, you get good news on inflation. So I think that is a very important signal that inflation could slow down quite significantly in the coming weeks, coming months.
And actually, we're going to get some readings this week. Stéphane, what do you expect?
I think we're in the window now, Martin, where this money supply signal should lead to better readings on inflation. If we don't get them, Martin, you'll get more hawkish central banks, yield curve inversion, much more difficult financial market conditions. So I'm hoping that this week we get better news on inflation due to this drop in money supply, but also all the other things that we spoke to in recent weeks as, supply chains starting to improve in the manufacturing sector, et cetera, et cetera. So I'm expecting better news on inflation.
Excellent. Let's end by talking about Canada. It's a bit of a sluggish economic environment. At least we're not down, but what's your read?
Well, again, when we compare ourselves to others, we might be stagnating, not much in terms of growth. If you look at what's circled, the month-to-month readings on GDP are not very impressive. So, but we're stagnating, as you said. It's better than a contraction, unlike other parts of the world. So I think that is key to slow inflation down in Canada. And this is what the Bank of Canada said. If we can get another few good readings on inflation, we will see a top on interest rates. So expect another increase in interest rates in Canada. But the good news is with slowing growth, inflation should decelerate more significantly in Canada in the coming months.
And we're seeing quite an impact on the real estate market.
Yeah, and Martin, the reason why we're seeing more deceleration in Canada is clearly one of the sectors that was doing very, very well throughout the pandemic is now cooling significantly and contributing to the slowdown in Canadian GDP growth. So home resale activity with the higher mortgage rates have clearly seen a significant deterioration. The good news, Martin, is that we might soon see a bottom on home resale activity just because immigration is so strong in Canada right now. The population is growing at the fastest pace in many years. So that provides some support for the residential market. But yes, Martin, we're seeing this big drop in resale activity across the country.
And what about prices?
Well, that's good news, Martin. Look, we can't have it all. Central banks are looking for lower prices, and they're seeing lowering prices. So home prices are down 4% since the recent peak in Canada. With the higher mortgage rates, Martin, we expect more downside. So in total, we would go back 15% below the previous peak. Some people will be discouraged when I say this, Martin, but if you keep things in perspective, that would bring us back to where home prices were at the start of 2021, which is a lesser bad under these circumstances.
So in conclusion, Stéphane, let's be really on top of inflation news coming out in the coming weeks. We do expect a significant increase in October, but we're sticking to a pause after that.
Well, Martin, the central banks are not saying they're going to pause. But if we're hoping for them to pause after October, we need to see better news on inflation. So again, the central banks are data dependent. We need that better news on inflation. If not, the markets will remain significantly volatile in the coming weeks. So it's this inflation reading becomes extremely important going forward.
And there's been a good pullback in rates. Is it tempting?
Well, you look at the fixed income markets, Martin, rates have increased significantly. I think if we see a top, if you think about a potential top on interest rates, I think we're closer to a peak now. I think it becomes a more interesting entry point to start looking at the fixed income component of the portfolio. Again, if that inflation slows, it becomes more interesting.
Excellent. Thank you very much, Stéfane. Thank you for listening. Keep sending us your questions. Be safe out there, and we'll see you in about a month. Thank you.